Good morning and welcome. My name is Bill Peffer. I am a lawyer in the business department at Montgomery McCracken, and I'd like to thank you all for being here. We have a fantastic, Tara is at the end, so whenever I see her smile and her laugh, I think that way. We have a fantastic panel organized today to talk about business succession planning issues and topics around business succession planning. As you all know, if you're a business owner or a son or a daughter in a family-held business or a closely held business, succession planning is key to the future of your business. It's also something that we find, and you'll hear this, it's time and again ignored or pushed down the line. And, we get clients walking into our office that are 85 and they say, well, what do I want to do with my business? Our game plan today is we're going to have each of our presenters speak for 5 to 10 minutes or so. At the end, we will then have a question and answer session. As you can tell, this is not a presidential debate, so we can relax our standards just a little bit. If you have a burning question that you really want to ask after someone speaks, by all means, we can field a question or two. The concept really, you all have been to these types of things. These things are really, they only work if you get something out of them. And if you have a question, by all means, please feel free to ask. Our overall goal is to get you out of here by 9:45, to get you a little information about succession planning. If you have a plan in place, to maybe give you some things to think about. If you don't have a plan, to get you started in putting one in place. Today, here, our distinguished panel, we have Eric Settle, who's with CMF Wealth Management. Eric is a wealth manager and also a reformed lawyer. Also with Eric is Mike Feldman, who's also from CMS, who's going to help me do some moderating as well. Howard Vigderman, who is the chair of the estates practice at Montgomery McCracken. Scott Isdaner, who's the managing member of Isdaner & Company. And last but not least, and Tara goes last because she is the most entertaining. She also, for those of you who own a business and might be looking to sell a business, she's going to give you some tips on how to increase the value of the business. So with that, Eric, podium here. I just didn't want to sit down. So.
Okay. Thanks, Bill. Look, business succession is unavoidable, okay? Either you are going to sell the business, you're going to close the business, or they're going to carry you out in a box. And for many business owners, that third option sometimes seems more palatable than dealing with the various issues that come with business succession planning. I'm reminded of that Nationwide commercial that's running recently where people would rather clean their gutters or wash the dog or wash the floors than meet with their financial advisor. And the reason that's funny is because it's true. And that's one of the issues. And why is it so hard? Well, first of all, it's emotional. If you think about it, so much of what we do is tied up in what we do and how we do it. And for business owners particularly, it's much of what they own. And so it's emotional. It's almost like their child. And if you think back, for those of you who used to have minor children like I did, and for those who still have minor children, when you did estate planning around the kids, who was going to get the kids, that was the hardest issue. In other words, the money wasn't as big a deal as, were we leaving who was going to get the kids? And so I think for business owners, business succession is about what to do with their child. Second, it is financial. Look, the reality is that most business owners live their entire financial life through their businesses, their salary, their cars, their clubs, their vacations, all seeking to make it business-oriented if possible. So the fact of the matter is that it is important. And oftentimes we'll sit down with the business owner when we're doing this kind of planning, we'll say, well, what do you draw out of the business? And they'll give us some number, and we'll sort of look and we'll say, that number supports your lifestyle completely? And they sort of look at you and go, well, not really. So the truth is that we know that business owners use their businesses as part of their overall wealth. So the mental hurdle for the business owner is, how do I take this business that's supported my life for years, and maybe even for generations, and convert it into a defined pile of cash? And that's really the way you have to look at it. So the fundamental question that business owners ask us is, how big does that pile need to be? Now, it's not how much the company's worth. That's Tara's job, and that's not what we're talking about. It's how big does the pile have to be to make sure that I can do all the things I want to do for myself, for my family, perhaps for charity. And it's often for all those reasons. And that's what we try to do. And it's an important question whether you're selling the business or whether you're trying to transfer the business to another generation. And in some ways, Scott and Howard will talk about some of the efficient ways that that can be done. And if you can't get the pile big enough, okay, is there a way to get there? And so one of the things that we commonly see is consulting agreements, where a business owner is paid for several years to get them from here to what I would describe as a more traditional retirement age. And in the end, that's Bill's job to come up with those kinds of things. But it's our job to identify a plan that works, so that when you go out and negotiate a deal, you already know what's important. I know as a recovering lawyer, I know that when I negotiated deals, I needed to know what was important and what was not important to my client. And similarly here, knowing what that pile, what that numbers needs to be at the end of the day, allows you to go into those negotiations. So the question is how big does the pile have to be? And the answer, it depends, and it depends on two big things. How much do you spend, and how much risk are you willing to take? In the materials that I have provided to you, I borrowed some charts from my friends at AllianceBernstein, where I had the privilege of spending 6 years, and I must tell you, they work really hard at this kind of stuff, and I think the materials they come up with and the data they come up with are some of the best. So here's the rough estimate, okay? If you're 50 years old, and you spend about $250,000 a year, and you can tolerate a balanced portfolio, so that would be kind of the traditional 60% stocks, 40% bonds, the answer is about $10 million, okay? If you're 65, the number is closer to 7. By contrast, if you want a more conservative portfolio, say 20% stocks and 80% fixed income, which is pretty typical of business owners who take a lot of risk when they're running their businesses, but take a lot less risk when they're investing money. The numbers are 14 million if you were in your 50s and 9 million in your 60s. And if you're spending closer to $500,000, which would not be atypical for a successful business owner, those numbers are 21 million and 16 million. So those are pretty big numbers, but that assumes that that assumes that A, the markets are hostile, okay, and it assumes inflation as well. Now there are things you can't control, like when they really will carry you out in a box, or what the capital market's going to do over 20 to 30 years, or frankly these days what the next set of tax policy is going to be. But this assumes a normal lifespan to age 95. Of course, our other job is to figure out what to do with that pile, and that's a topic for another day. But that gives you sort of a parameter of why it's hard and what you're looking for. Look, as professionals, we know that one of the biggest hurdles is getting started. Well, you showed up this morning, which we appreciate, and it's a good step forward. We hope that myself and our panelists will give us some ideas about how to move forward or confirm some of the ideas you already had. As I said at the outset, this is not easy, but it's better than cleaning your gutters. Thanks for listening. Scott?
Yeah. I'm going to say, if that's okay. I think based on what Eric's saying, I ought to work until I'm carried out in the box, because those numbers that he's projecting are pretty high. My name's Howard Vingerman. I'm not a recovered lawyer. I'm a practicing lawyer, and I'm a trust and estates lawyer. And what I'll be talking about is what estate planning is. And I think people generally think of estate planning as being very tax oriented, and what we really do is help people save tax, which is a lot of what we do, maybe even for some clients it's most of what we do. But the way I like to describe what an estates lawyer does and what an estate planner does is really dealing with changes in people's lives. which could be the acquisition of a business, the maturity of a business, succession of a business, selling a business, getting married, getting divorced, going bankrupt, having children, having grandchildren, dealing with beneficiaries with disabilities, dealing with your own disability, all those kinds of things, the mix of things that happen in people's lives are what we estates lawyers deal with. So by way of example, one of the documents that we prepare for all of our clients is a power of attorney. And it gives somebody called an agent the authority to manage your assets, including your business, if you become disabled or if you're out of the country and can't run it on your own. That's very important, because if you were to become disabled, you would want the business to be able to either be sold in an orderly way by somebody who's competent to do it, or to continue to be run by somebody who really understands the business well. So that's an important part of what we do. Another thing that we very frequently do is we have assets transferred either during an individual's life or at death, not necessarily outright to family members, but in a trust for family members. And a benefit of trusts is that it's easier to control the operation and the governance of a business if in the trust agreement that you're creating, you direct who's going to be in charge of running the business, who's going to be able to vote the shares, who's going to decide if the company is sold, who's going to decide what happens if a minority shareholder wants to be bought out, and what opportunities the other shareholders have to buy the stock. All those kinds of things can be done through the vehicle of a trust. I think that people commonly think that a trust means a bank. You know, they have in their head sort of the Mary Poppins view of the Fidelity Fiduciary Bank, where you have to go to the banker and ask for 5 cents to go to have breakfast. It doesn't work that way anymore. We draft our trusts in a very, very flexible way so that family members who are knowledgeable and who are flexible and really understand how the family operates and how the business operates can serve as trustee. Another benefit of trusts that a lot of clients like, and often when I talk to clients, they sort of glaze over until I mention this one subject, which is making sure that their family assets don't end up in the hands of their sons and daughters-in-law. Well, of course, they love their sons and daughters-in-law. They adore their sons and daughters-in-law, but they don't want their hard-earned money to end up in their hands. Trusts can assure that the children are taken care of and that the grandchildren are taken care of without the money falling into the hands of somebody who's not within the family that your client wants to benefit. Let me talk a little bit about taxes. And of course, with a new administration, it's not really easy to say what the tax picture, the estate and gift tax picture, is going to be going forward. At the moment, there's a federal estate tax, there's a Pennsylvania inheritance tax. If you live in New Jersey abolished its estate tax, but it still has an inheritance tax. The federal estate tax rate today is 40%, and the exemption is roughly $5.5 million, and for a married couple, it's roughly $11 million. If your estate is over that amount, on the death of husband and wife, the government is going to get 40% of your assets. And don't think that that doesn't include things like retirement accounts and life insurance. Those are included in the mix also. So a lot of the things that I do and help clients with is giving away their assets during their life so that the appreciation on those assets between the date that they give it away and the date that the government would get its cut, which is when they die, that appreciation is removed from their estates and therefore not subject to tax. So if I have my client has a business that's worth $5 million today, and they give to their children $1 million worth of stock, and when they die, that $1 million is worth $3 million, they've removed from their estate $2 million of appreciation. Often we recommend that be done by transferring the interest in the company, whether it's an LLC or a corporation or a partnership, to a trust, as I said earlier, in order to, among other things, sort of maintain cohesiveness and control of the management of the business. Then there are gifts that I would call, and this is my term, this isn't a term of art, I would call them delayed gifts. These are gifts where you make the gift now, but you retain an interest in the gift that, that reduces the value of the gift that you report to the government. The classic example of that in a business context is called a grantor retained annuity trust, where I take stock in a business, transfer it to a trust, the client retains a fixed annuity to be paid from the trust each year, and then at the end of the grantor retained annuity trust, which can be 2 years long or 5 years long or 10 years long, whatever's left passes on to the children. The value of the gift that's made is the value of the stock that goes into the trust minus the value of the annuity. And the annuity can be structured in such a way that the annuity equals the value of the gift, which means the value of the gift is 0. So what remains in the trust at the end of the GRAT is only the appreciation between the date of the gift and the date that the trust ends. Okay? Now, of course, that technique would be unnecessary if the Trump plan were to go through and they were to abolish the estate tax. So everything that I'm talking about is subject to the possibility of the abolition of the estate tax, and I'll talk for 30 seconds about what the Trump plan would be. Another very commonly used technique is where the owner of the stock sells the interest in the stock to a trust for the benefit of the children in exchange for a note. Okay? And the note is required to have a minimum amount of interest as dictated by the IRS tables, and because interest rates are low, the amount that is required to be paid to the senior generation that's selling is a low number. And all the appreciation is therefore parked in the trust for the benefit of the children, and if the business is doing well, the stock will go up, but what the senior generation owns, which is the note, is an asset that doesn't appreciate in value and pays a minimal amount, or it can be really any amount that's negotiated back to the senior generation. And finally, the last technique that I'll talk about that reduces the value of the gift are what I'll call the valuation discounts. Okay, so if I have a business and I transfer it to a child, and there's an agreement between the parent and the child that the child cannot sell the child's interest in the company without first offering it to the parent. Or if there's an offer made to the parent by a third party, the child is required to sell to the third party if the parent sells to the third party. All of those kinds of things limit the value of the child's interest in the business. So if the business is worth $10 million and the parent gives 10% to the child, for estate and gift tax purposes, applying the discounts, the child's interest, instead of being worth 1/10 of 10 million, is only worth $800,000 or $750,000 or something like that. Now, all of this has to be looked at carefully. There has to be a business appraisal. Somebody has to really determine what the value of those discounts is. But that's another way of turning a gift that's this big into a gift that for tax purposes is only that big. Okay? So those are some of the things that we as estates lawyers do to save clients money from an estate and gift tax perspective. The last comment that I'll make is about the Obama plan, which I'll confess I have not read the entire plan, but as I'm sorry, the Trump plan, I'm sorry.
Freudian slip.
We know the Obama plan.
Yeah, we know the Obama plan, that's the exception that we have now. The Trump plan is basically what I'll call the Canadian system. It's a mark-to-market plan where when an individual dies, all their assets are deemed to be sold for their fair market value, and there's a capital gain that's taxed at 20%. And there's a $10 million exemption from the capital gain, and honestly, I don't know if it's the amount of the gain or the fair market value of the assets up to 10 million. I haven't looked at that in that level of detail. But basically, there would still, under the Trump plan, continue to be an estate tax, but it wouldn't be called an estate tax. It's really a capital gains tax. And so a lot of the techniques that I was talking about today to save tax would still have some application under a Trump plan. So we will keep those things in mind as we see how that plan develops and whether it actually becomes law.
Scott?
I'm Scott Isdaner, and welcome. Before I start, I did have a question for Howard. The technique with valuation discounts was under attack by the current administration. Regulations have been issued earlier this year that would curtail the ability to value some of these transfers at deep discounts. What's your prognosis about whether those regulations are going to see the light of day now?
Well, the IRS, as you would expect, has always had a disdain for the valuation discounts. And when you file a return where a discount is taken, you know that the discount is what the IRS is going to be focused on. In fact, on a gift tax return, if you take a discount, you have to check a box on the gift tax return so the IRS knows exactly where to focus. The regulations that Scott is talking about are supposed to be the subject of sort of a hearing or something or other before the IRS. I think it's supposed to be the first week in December. And if those regulations were passed, then some people's reading of them is that the discounts would go away. Now, the person who wrote the regulation says that's not true, that's not what I said or what I meant to say. But if in fact the IRS proceeds with those regulations and under a Trump presidency those regulations are allowed to go forward, then the discounts may fall by the wayside. I'm the last person in the world to be a Washington prognosticator, but I'm guessing that with all of estate tax possibly going away, that the focus on making those regulations permanent is probably lower on the IRS's list of priorities. So I personally, in my practice, am not as focused on them as I would have been had the election turned out differently.
Yeah, we were, there was a question.
Yeah.
Under the Trump plan, who determines fair market value when you have non-liquid assets?
Well, I'm assuming that it would be done the way it is now, which is the taxpayer files a tax return, hires an appraiser if it's a hard to value asset, and then the IRS has the opportunity to challenge the values.
The concept of valuation and the complexities won't go away. Just the consequences and the cost, it may just be a lot less. So far we've considered from Eric whether you can afford to sell your business, and Howard has provided us with an extensive range of estate and family planning considerations to help to get your house in order before you make the decision of whether you're going to go forward and do something with the business that you've created or built through many generations. I think one thing is really clear from both their conversations, and I'm sure it will come out from Howard's conversation. The word succession is not as important as the word planning is in our topic here today. And proper and advanced planning and everything that you do will lead you more likely to get to the results that you're trying to achieve. Just as a recent example, we just recently had a client complete a very successful sale of his business. It was a 10-year plan that the client implemented, first to transfer 20% of his company's interest to his children using a technique that Howard described called a grant or retained annuity trust, or a GRAT, where he was able to basically get 20% of the value of his company over into trust for the benefit of his children. That GRAT was a five-year term GRAT, so it had to get aged and completed before the contemplation of selling took place. Following that, clients spent a lot of time getting their financial house in order. working with people like Tara and ensuring that you were able to maximize the value of the company. Because after all, the pile that Eric talked about, the critical number, is a number that comes into play because you've created value for your company, and secondly, you've planned the sale of your company in a way to reduce as best as possible taxation, because the number that's left to invest to support your lifestyle is an after-tax number. And that's what I'm going to address a little bit today, which is the income tax consequences of what happens when you sell a company. Couple of things, just a little housekeeping. There are a lot of considerations when you go down the road and decide it's time to sell your company to a third party. And I'm not going to be able to address in the few moments we have here today several impacts that have to be considered. Right? I just want to point them out because these are things that you'll have to start thinking about early. There's always the issue of addressing the issue of secrecy versus open communications inside your company amongst your employees about whether what you're going to be doing with your company. It affects morale, it affects the ability to maintain the company's operational structure and profitability. You have to know your core staff, your employees, and what the impact will be of their disclosure, or better for them to find out the day after the sale occurs. In the case of the client I just mentioned, the announcement of the sale occurred following the sale. And the owner met with his entire employee base and had checks in hand as bonuses for every one of them to sort of compensate them for the shock that they had just learned about what happened. Building your key employees, if you have a company that has depth, is also a long-term planning process, and there are significant tax consequences about how you reward key employees to help you to achieve the value of your company, whether it's in the form of compensation arrangements, whether you're looking into issues of actually giving employees a share of the company through equity, or using other techniques like phantom stock, which is in effect another type of employment arrangement. All these things, again, should be planned out and thought in advance so that you know that you're going to have your team in place to help maximize your value. And getting your financial house in order and understanding what drives value is really critical, and planning and operating your business is important. So let's talk tax for a couple of minutes. From an income tax perspective, when you're looking to sell your company, the real issues that you have to address is understanding the difference in our current tax system between capital gains and ordinary income. Capital gains are gains that create a much lower effective tax rate on a sale. Ordinary income is a much higher rate. So the goal in any type of sale planning is to try to maximize the portion of the sale as capital gain and minimize to the fullest extent possible the amount of the gain that's going to be ordinary. And I'm going to talk about a couple of items that are important to do this. But under today's world, capital gains are taxed at a maximum of 20% for federal tax purposes. Ordinary income is taxed as high as 39.6%. Many of you may have heard about an additional tax called Obama tax, the Obamacare tax. It's a 3.8% tax on top of this. For most business owners who are actively involved and maturely engaged in their business, the gain from the sale of their business will not generate that tax. It only really applies to those who are not actively involved. So if you have minority owners who are not involved, or outside shareholders or investors, their portion of the sale could be subject to this additional tax rate under current law. And as Howard said, the world is likely going to change next year, and I'll just touch on that briefly after I finish my comments. So typically when you have a company, and again, the first thing that's very important to know and to analyze is the structure of your company, because it will often determine the consequences of the sale. Most companies operate either as a corporation or as a LLC or a partnership. For tax purposes, I sort of lump LLCs and partnerships into the same category. But we'll start with the corporate side. The simplest way to guarantee a capital gain on selling a company is to sell your equity interest in your company. So if you have a corporation that is taxed as what's called a C corporation, which means it's a company that pays its taxes. It's not a company whose income is passed out and taxed to the shareholders. That type of company is called an S corporation, and I'll address that in a second. If you sell your stock in your C corporation, that stock sale is akin to selling any kind of capital asset, just as if you sold stock in Apple or IBM that you own, and the gain that you would recognize from the sale of that stock would be capital gain. And that, again, provides you a favorable rate of 20%. Obviously, the lower your rate, the less tax you pay, the more money is left in your pile to enable Eric to help you to achieve your cash flow needs to continue with you and your family's lifestyle. The alternative in a C corporation, which is a very onerous solution, is to sell the assets of your company to a buyer. And that's because C corporations are one of the few remaining entities that are still subject to double taxation. If you sell the assets of your C corporation, that sale will generate a tax at the corporate level, and then when the corporation distributes the after-tax proceeds to you as the shareholder, that will again generate an additional level of tax. So typically with C corporations, the goal of the owner is to sell the stock because the level of double taxation can significantly impair the after-tax proceeds available. The other side of the coin is, and we're not talking about, but we're talking about sellers today, is the buyer. And to a buyer, buying stock is not necessarily as beneficial a acquisition technique as buying assets of a company, because a buyer is seeking to try to maximize their after-tax return on their acquisition. And if they buy assets in a company, they're able to create basis in those assets because they've paid for them. And then they can use depreciation and other tax techniques to be able to take write-offs for that acquisition. They can't do that if they buy the stock of your C corporation. So for a buyer, when they're looking at the actual cost of the acquisition, they often are looking to try to achieve their benefits through asset acquisitions as opposed to stock acquisitions. So C corporations in and of themselves often pose very complicated and difficult negotiations because of the higher level of tax on the seller with an asset sale versus a buyer who's looking for asset sale purchase versus stock. Most of our client base that we work with in our firm are not C corporations. People having trouble hearing me? I project pretty.
There's a piano on the next row.
Is that right? I'm sorry. Is that better? Most of our clients are structured as flow-through entities. And the first type of flow-through entity that many of our clients are structured as are S corporations. Again, these are companies that are eligible to be treated as under the Internal Revenue Code are called small businesses. Elections are made, and the income of those entities passes through to the owners and is taxed only at one level. The result is whether you sell your stock or you sell your assets of an S corporation, for the seller's perspective, there will only be one level of tax, which makes the negotiation process a lot easier. Again, if you sell the stock of an S corporation, it's a capital gain, and your gain is taxed at a maximum 20% rate. If you sell your assets of an S corporation, the difference that can create a higher level of tax is that some of the assets that are owned by your company may be tainted under the federal tax law, and the result is that a portion of those gains could be subject to tax at higher ordinary income rates. The classic example of this type of tainted asset is an asset that you've fully depreciated, plant and equipment, or a building. And when you sell that asset based on an appraised fair market value or negotiated purchase price, to the extent that you previously depreciated that asset, the gain up to the extent of that former depreciation is recaptured as ordinary income under the tax law. So in effect, even though you're selling your assets and only going to be paying one level of tax, the actual overall tax cost to you could be greater by virtue of creating an asset sale versus a stock sale. In the transaction that we recently were involved with a client, the client told the buyer, I am agnostic as to whether you buy my stock or assets, as long as you make me whole. So that at the end of the day, I am only paying a level of tax equal to what I would have paid had I sold my stock. So if the buyer was interested in getting a basis adjustment for the purchase by getting the assets, the extra additional tax costs that our client would pay was made up through a purchase price adjustment as part of the closing. And that way he will end up getting dollars back that will both take into account the additional tax and, in effect, through a complicated formula, compensate him also in addition to the fact that that additional purchase price is taxable. So it's kind of a circular calculation, but at the end of the day, a calculation will be done where he will get an additional lump sum on the sale that will cover the additional tax cost that enabled the buyer to get a basis in these assets that they were purchasing. Very often, very often, the buyer will want to buy stock because they don't want to disrupt the fact of the operational integrity of the company, all the contracts that have been signed in the company's name, because an asset sale creates a whole new entity for the buyer, and dealing with titling of assets and can be much more complicated. In the subchapter S world, there's a solution to this where you can have your cake and eat it too. There's a provision in the tax law. I don't like to use code sections, but in this case it's an important one. It's called a 338H10 election, in which a buyer and the seller can agree to make an election to treat a stock sale as though it were an asset sale. And it basically puts the seller into a position as if he had sold his assets, even though in reality it was a stock sale. Again, in the case of this recent transaction, there's going to be a 338H10 election that's going to be made, and the buyer will get their depreciation benefits as though they have acquired the assets, even though they're just acquiring the stock of the company. And on the other side, the seller is going to be made whole, so he'll be in the same position as if he sold his stock. The other item that I want to talk about is entities like partnerships and LLCs. Even though the income of those entities flows through and is taxed, so there's only to the owners, and so there's only an individual one level of tax rate on that. They're a hybrid for tax purposes. So even though if you sell your partnership interest or your LLC interest versus selling the assets, in either case, the concept of tainted assets continues to carry through on the sale. So that if you sold the LLC interest or membership interest or partnership interest that you own, you normally would think that that would be all capital gain, just as if you sold your stock in your S corporation. But because the hybrid rules of partnership taxation in effect, the portion of the gain attributable to assets that were tainted, and I spoke about that with the S corporation, things that have been depreciated, for example, that taint remains. So whether you sell the entity or you sell the assets, you have to address and deal with the fact that there will be an additional portion of the gain subject to a higher rate of tax. From the buyer's perspective, whether they buy your interest or they buy the assets, typically if they're buying a significant portion of your company under either approach, there are mechanisms in place to allow them to get a basis in the assets they buy, so they'll be able to depreciate them and get the same benefits as though they bought the assets either way. So that's a good news. The other item to deal with that has to be addressed at all times is what happens if you want to retain an interest in your company. Very often in transactions involving private equity purchasers, the existing owners want to retain a piece of the company because the owners may continue to operate and run or be involved in the business for a period of years. Very often you'll see owners wanting to keep a 20% interest and the private equity firm wanting to purchase 80%. There are ways to structure those transactions so that the 20% retained ownership interest can be done on a pre-tax basis. So in effect, you don't have to sell 100% of your company and then take, on an after-tax basis, 20% of your proceeds to reinvest in your company. But you can retain that 20% using pre-tax dollars. And there are ways to structure these sales to achieve those goals. And again, a little bit beyond this, but it's an important structural component. With that, I want to just briefly mention two other things. One is state taxation comes into play in all of these transactions. So in addition to the federal income taxation, there are state tax components. Pennsylvania is currently a fairly low income tax state. Our rates are 3.07%. So it's less of an issue often in Pennsylvania, but other states have much higher tax brackets. Operating in New York or California can be a very costly additional tax burden on sale. And the other item is that often as part of the sale, a buyer is going to insist that you as a seller agree not to compete and sign waivers or covenants not to compete. Those types of provisions and agreements typically generate ordinary income, not capital gain. So very important to the process, just in structuring, to understand the consequences of those types of arrangements and try to minimize the costs. Lastly, before I turn over to Tara, is everything going to change next year? I know that's the question that Howard addressed, and it's an important consideration. I think for purposes of sellers, of companies, and high net worth taxpayers, the changes next year should, in large part, if they occur, be beneficial. Both the Trump proposal and the plan of income taxation that's been proposed by Speaker Ryan and the chairman of the Ways and Means Committee call for a flatter type tax with lower tax rates, fewer deductions, an elimination of the alternative minimum tax, which is a parallel tax system now that's quite complicated and captures a lot of people into a tax net that was unintended originally. A lot remains to be seen, but with a lower difference between ordinary income and capital gain, some of the issues involving the sale become less onerous and will help you to achieve your goals sooner and possibly earlier than you thought you could. So with that, Tara.
7th inning stretch.
Tara, take that microphone.
Yeah.
Now they're laughing next door.
I know. Well, do we have anything to laugh about? Can you guys hear me okay? All right. So I think I should speed this up because we want to be out here at 9:30, right? Yeah, and we want to ask some questions. So before I launch into my little chit chat here, it's just, I have great respect for the technical knowledge that my colleagues have here, and in particular Howard. When listening to him, I'm sure you've picked up on, gee, this isn't really easy to just snap together a trust or to make sure that you've got the right structure. And Scott, I'm not sure if you picked this up from his bio or not, but he is a CPA. He's an accountant by training, and
I'm a covered lawyer.
Oh, I didn't know that. I think I'm the only one up here that's not a lawyer. I'm a real person. No. We all are real people. But the real message here is that it does take a team to get your business sold. It takes a team to transfer your business owner or your interests over to other people in your family. But despite all the technicalities and the stuff, and we're just giving kind of the tip of the iceberg here, it is not an overwhelming process if you start with the team and you start with your attorneys. In fact, the attorneys are sort of the alpha and omega on deals, right? But Montgomery McCracken has a number of attorneys here today. Katie O'Brien is a corporate deal attorney. Bob Elwood does tax attorney time. Bill Keffer is also a corporate deal attorney, and then we have the trust and estate function out of Howard. But the point is that the journey of 1,000 miles begins with the first step, and the attorneys always kind of have your back on what your history is, what you need to be looking at doing here in terms of housekeeping, and how to get the process structured and moving along. So my firm, the Woodward Group, we are investment bankers. I think, there's some bio information on who I am on the back of the little chart, the bar chart thing, right? So that's information on kind of where I come from and what informs my perspective on things. But our firm is always the tail wagging the dog. We come at the end. By the time a company gets to, or a client gets to our offices, they've decided, hey, I want to sell my company. We also do valuation work. But what I want to talk about, hopefully, is something that touches on whether you continue to own your company, you gift it to your next generation, or you sell it. And that is just how do you maximize value? And there really are sort of 3 P's here. Your sort of proprietary business methodology, these are proprietary products, your profit, and your position in the market. And a lot of clients, this is partly why you get a team involved here, will say, well, I'm a service business, we're not proprietary, we don't have anything special here. And your advisors can help you uncover some of this. Proprietary doesn't just mean patents. It can also be a special way of doing your business. We sold the largest rebar fabricator on the East Coast. There are no patents in that. But the guy had figured out how to bundle the rebar, bend it, and get it to the work sites in a way that the construction people could really rapidly deploy the rebar into the construction process and save days of labor. So that was a very successful business with no patents. When I talk about profit, it's usually the gross profit margin, your gross profits divided by your revenues. And the higher that is relative to your competitors, the more valuable your business is. But it doesn't always have to be the gross profit margin. We have a client, a distribution business, several $100 million. Their gross profit margin is in the teens. I would say if you are, we have a medical device client with a gross profit margin 90%, right? But even with a gross profit margin in the teens, if you figured out how to manage your business in a proprietary way, you're golden. And the distribution business I'm talking about figured out how to manage their inventory and to distribute with 0 errors by writing their own software program. So those people clean up on their operating profits and on their operating profit margins. So that's a real value creator if you can do anything in your business to increase that profit margin. And then when I talk about position, if you're selling your business or even if you're continuing to own it, it really is, have you placed the business in a place where you are competitively, you've got some good competitive barriers relative to your competition, and or you've been able to anticipate, where's the market going? What are customers going to want to do? But you know what? If you don't have any of that, and you want to sell your business, right? You're still going to be able to maximize value, if you do 3 things. And one is you don't do it alone. You've got to hire professionals because the attorneys will come in and help you clean up your books and records. They will help you, plan to structure a deal where you're going to minimize taxes. They will help you figure out how to put makeup on the warts. So if your business really doesn't have all these beautiful attributes, you can still position it well in terms of approaching potential buyers. The other thing you can do, whether you've got proprietary products or a great gross profit margin or not, is do a 5-year forecast. A lot of businesses don't want to do that. They just want to do a 1-year budget. Who cares? And it's a pain, right, to do a 5-year forecast. That's how they really look at value. The third thing you can do if you're going to sell your business, pretend you're not, in the sense that you continue to run it, you manage it, you invest in it, and you love it as if you will own it forever. Because that both gives you the confidence to say no to a bad offer, but it also shows that you've got momentum and a focus going forward. So a couple of things, I'm going very fast, rapid facts, because we want time here to talk. So you'll see this little green bar chart thing in there, and that gives you current market multiples of earnings before interest, tax, depreciation, amortization in the market. And its focus is specifically middle market, okay? And these are deals that are between 1 million and 500 million in value. But that's the average, right? And so the range on this stuff is anywhere from 2.1 to 15.1 times EBITDA. The overall market is at 15.3 times EBITDA, pretty high. And, the message here is a couple of nuances. One, size matters, your profit margin matters. You want your business to be getting that higher end of the EBITDA multiple. And one of the ways you do that is through some of this positioning I'm talking about and through your team that is helping you sell this business. I would So I'm gonna like wrap this up. I would say I've thought about this whole, gee, we've got a new administration coming, what's that gonna mean to value, values of companies? And, you know, I think it's gonna matter on the tax side. I don't really see it mattering on the value side unless your company or the company that's being sold really does have a great deal of imported goods or components that they're using in creating their products. And we have several clients that are in that category. You know, we've heard things like, well, we're going to put a 35% tariff on all goods, you know, being shipped in over the Mexican border. And if that's true, that's going to hurt value because we're going to see drops in revenues. We're going to see increases in expenses and cost of goods sold and shrinking of profits. I think, you know, once we get into this new administration and some of these nuances are understood, that, you know, we really are, I see that, some eyes rolling. We can hope for like, but you know, our economy is a global economy. The world is flat. I mean, Thomas Friedman from the New York Times has written a great book called, you know, The World is Flat. And, you know, I see it in the M&A market here, final point. But, you know, when I said, you know, the overall market is a 15.3 times EBITDA multiple, a lot of that are the large deals, some of which have failed in 2016 for a variety of reasons. But, you know, 2/3 of the buyers in the overall M&A market are from overseas. They're inbound, and they're mainly from Asia, and a lot of it's coming from Japan because we have negative interest rates there. I mean, they can, you know, essentially buy your business, you know, for no money or for no interest expense. So, having said all of that, churn and blah blah blah, I think we're left to what, like 5 minutes for questions.
Yeah. So why don't we? I mean, very patient. To start out, see if there's anyone out in the audience. I have a couple of questions which I'll, you know, run. But if there's, you know, if anyone has anything that they want to ask, by all means. So I guess the you know, I'll just go with the 2 or 3 quick ones, and we'll get out of here in about 10 minutes. So I guess the first question I have is Scott, I heard you say something like you had a client that had a 10-year plan. You know, for folks sitting in the audience who are just waking up and saying, geez, I better do something. What do we, you know, does everyone need 10 years to do this? Can we get it done in 3 years? Can we get it done in 2 years? What's the, you know, where do you, obviously time is the longer the better, but what do you think? And you gotta go with
I
it.
don't know if you want to tackle first, because you see valuation issues in the building. I think 10 years is a long time horizon and probably unusual in what we've seen with most of our clients. Most of our clients have gone through the process. It's usually been a 3 to 5 year process. To Tara's point, starting now to know what your next 3 to 5 years are going to be, and then projecting out beyond that is critical to being able to maximize your value. And if you're being properly led by someone who knows the process, you'll know that you need that much lead time. You know, really profitable businesses, sometimes you can turn it around fairly quickly because you're in a unique place in the market, and that lead time is not necessary. But to implement the types of things that Howard's talked about, to create value, you know, we typically see that 3 to 5 year period as being sort of the key to get started, at least, if not longer.
I would just add, you know, it also depends on the kind of company you've got. There are a lot of companies that are hyper well organized, well suited, and
So they
you know,
can from day one.
they can do it from day one. I mean, the fastest deal I ever did is I don't know if you know the Tyvek envelopes that were used in FedEx for many years. That company that manufactured those envelopes, International Envelope, rolled in on Halloween, and we got it closed December 31st. But you know, that's because it was a well-organized, well-positioned company. And you know what you need to do work-wise on your own companies. I don't think it really, you know, needs to take 3 to 5 years, but you you know, the best companies have either already implemented the plan or they've got a plan to fix what the, you know, where the warts are.
Yeah, I wasn't trying to say it takes 3 to 5 years to sell. It's the planning to get to the point. When you want to sell, and you go through the process, this large sale that just took place, it was a 5 to 6 month period from the time they said, let the world know we're available for a sale to closing. So, you know, the sale itself will not take 3 to 5 years.
Okay. So I'll throw this over to Mike over here, and I guess the you know, a lot of people they have this concept, yes, want to do this, want to do this, want to do this, but they never do it until something happens. So I guess, you know, Mike, in your experience, you've been involved with you know, a lot of businesses. What's the first step that you would give advice to clients to say, listen, do this? Do you go see your accountant? Do you go see your lawyer? By the way, we have Tara's on retainer for Montgomery McCracken. You know, she's in our public relations department. So you don't have to say go see the lawyers at Montgomery McCracken. But what do you say, Mike? What's your first thing?
I think you have to approach it from several levels, but you have to get comfortable with the idea that at some point in your life, your baby is going to be put out for adoption. You're going to sell this. You're going to sell it to your existing workforce, key people. You're going to sell it to an outsider. In most instances, this is our experience, the seller, meaning you, wants to be comfortable with the new parents. You want those adopted parents to be screened, to run your baby the way you want to. That could be a good and bad effort. In some instances, you don't care. But in most instances, if you're self-directed, you've built the business over many, many years, and I'll give you an experience. One of our clients, 10 years of a client, we started planning their sale of the business 5 years ago. And we built a whole model of what he wanted in terms of dollars and cents, things that he wanted to go to his children. We brought in appropriate counsel, both tax and legal. I think that's very, very key to get started right now. And so the panel up here are people you do want to talk to, even if you have just general questions and you have existing tax and legal counsel. You've heard a lot of good ideas up here. The fact of the matter is you need to pull together a team. I think that's where you all need to go. And even if you're saying, well, I might not sell for 5 or 7 or 3, whatever the number is, what is it going to take for you to make that leap? Because it is a leap. You're changing your whole life. Because if you built the business from scratch, or you bought the business and you've grown it and groomed it, it is your baby, as Eric pointed out. And it's very hard to give up your parentage of that child. You really want to take it. And what we do as a team, working with the accountant and lawyers and valuation specialists, is build a model that works. And this client, who just literally sold last week at the price he wanted, we ran no less than 10 different models. If I get this lump sum now, if I defer it and take more in the back, what does he need, and his wife and children? And his children are all grown. He just got the last out of college. We had a big celebration for him. And they're on their way to making their own lives. But he had a partner all the way along. The partner and the new business merged together. So he's out, but he'll be consulting for a period of anywhere from 6 to 18 months. And that was key to him, because it is his child. He was the marketing force behind it. But we were able to develop a plan that literally, month by month and year by year, we got him closer and closer to his goal. Please.
Yeah, just comment.
Yes, Jeff.
Sparked by the metaphor of a baby being adopted out.
Yes.
From a psychological point of view, which
Please.
is my world.
Why don't you come up, Jay?
No,
Oh, you sit there.
it'll be real quick. It's incredibly complex process we're talking about here, and as you said, it requires a team. And there's a new language being talked about. I just saw an article the other day that shifts from succession planning to continuity planning, which is a broader lens. and implies the need for more advice and a true team approach, which I think is aspired to, but it doesn't happen as often as it.
Jay and I met for the first time today, and he's a psychologist. And I said, you know, I could have used you in many instances. You know, one of my favorite war stories, it won't take a second, but this may resonate with the group. It's family-owned business. 3 sons were inheriting from the parents. Literally, every sit-down meeting we had with the attorneys and the accountants was the only time they ever talked about transitioning the business from mom and dad. And at those meetings, we had yelling, screaming, door slamming, etc. Tara's laughing because she's been there, and I'm sure we all have. And so what you want to do is get the team working on solving these problems. And sometimes it will take, or it's highly recommended to have a psychologist talk to everybody and find out what they really want.
Exactly.
The biggest issue for this family was one son had been in the business with mom and dad for 24 years, right out of college. The other one 10 years. And mom and dad wanted to give a third away to the one son who was there 6 months. Hello, fireworks. And
Fair versus equal is a
yes, a huge issue. So there's lots of issues, but you have to start with the first step. And this panel was here to talk to you about it and possibly assist you. So I thank you all for coming. Question, please.
What happens when the deal doesn't work? It must be something in the Chestnut Hill water, but I have a lot of friends who sold. They missed something. The company was run down. They bought it back at a discount, but it was horrific for everybody. And I know a deal is a deal and it's final, but sometimes you got to go and get it back sometimes.
Okay, that's a very valid point. So your question is?
I mean, I know you probably can't put that into a deal, but it does happen.
Well, you could possibly.
That's where your document that gets drafted is important. Obviously, also, if you've been paid a big pile of cash, you have a pile of cash to go back and buy the company back. And we've seen clients do just that. It's not something that they want to do. Sometimes you have a transaction where you have take-back financing. So in those scenarios, you know, there's a situation where the seller has sold but not really. So there's remedies. It's always deal specific. And obviously, most people don't approach a deal thinking it's going to go in the toilet, but they do. So it just happens, you know, however, if the client has that issue or that situation, it can be set up in the contract.
You know, just another comment on that. If you know, if you've taken all of your risk off the table at the sale, at the time of sale, so you've cashed out now, that's much more of an emotional issue about what happens when the buyer is takes what you've created and does not perform with it. One of our clients sold his company years ago to a large private equity firm, a nationally known firm. 5 years later, the company went bankrupt and doesn't exist anymore. And the value of that company was over $1 billion at the time of the sale. So there was a lot of issues. He doesn't have seller's remorse. He's fine, but he feels very sad that so many of his employees and other people got harmed by what he views as gross mismanagement of the company after the sale. But again, he had taken all the risk off the table, so he had no say. But to Bill's point, if you have still have skin in the game, then you better be sure that your documents give you that chance to step back in.
So that was a real good question.
I just wanted to add, there's an opportunity there, obviously. I mean, we had a client, we sold the business for $42 million. 4 years later, he bought it back for 13, and he ended up flipping it again for 100.
Yeah.
So, there's a dynamism to that ability to save. Save the day, right?
Can you introduce us to that person?
and also, it's very important that you have your goals, not just your personal financial goals, but what you would like to see happen to the company after sale. We had a client who chose to sell to a purchaser at a lower amount than what he was able to obtain on the marketplace, because he knew the higher purchasing buyer was going to take the company, basically fold it up and take the manufacturing operations and consolidate them offshore, so that all of his employees would lose their positions, and that was more important to him to preserve than it was the extra dollars that he was able to obtain. So it's how closely tied you are that matters.
So it's getting on to about 9:45-ish. If there's any other questions, we're going to be around for 10, 15 minutes or so, feel free to come on up or otherwise. We'll close it out with one more.
Great. Can anyone have a point of view on an ESOP as an exit strategy?
ESOPs?
Well, I'm not an employee benefits lawyer, but what I can tell you is, while it's an interesting technique and a lot of people talk about it, I think it's used a lot less than it's actually talked about. And to the extent that I understand them, I think one of the negatives about it is that as your employees who are the owners of the ESOP begin to retire, you need cash within the ESOP to buy them out, which means the company has to be able to generate that kind of cash. And if your employees sort of retire, a bunch at a time, that can become very expensive. So you really have to sort of forecast going forward whether the cash flow of the company is going to allow the ESOP to work. But it does, one of the huge benefits of the ESOP is it sort of solves the problem that Scott's talking about sort of disenfranchising your employees. If you're essentially selling the company to your employees, and therefore they can reap the benefits of the efforts that they've provided in growing the company to increase their own wealth. So it certainly does have its place.
I think there are some significant tax benefits if you're able to achieve a structure through an ESOP, because often a lot of the income generated becomes tax-free, so there's less tax owed in the post-transaction. That enables there to be more money in the pot to be able to sell or to get the dollars they need from the sale. But they're complicated transactions. They're typically, some firms and experts that deal only with ESOP transactions.
I would just add, there is a big hassle factor. I mean, under Department of Labor regs, you have to value this every year. I used to value the WL Gore Associates ESOP every quarter for them. A lot of effort spent on educating the employees on what the stock even meant. A lot of them just did. I also had annual Apt Associates up in Cambridge was another client. And we have a client right now that's unwrapped out of the ESOP. They just never really got the sort of, hey, I own this business, I'll be pulling the sled and acting like an equity owner. They just never got that effect out of it. And the sort of admin hassle and expense really kind of drove it away.
Yeah, there really is a big cost and factor like that.
But one of my invitees who didn't come today will be sorry, because that's all he does is ESOP. So I'll give you his contact name.
All right, well, thank you all. Have a great day, and going